Hello, everybody. Mr. Foley here. Apparently, this is the balloon edition of my video. A random balloon that's static clung to the ceiling. So there you go. All right, today we're talking about GDP, gross domestic product. And it's not because it's like gross, like ishy. It means a large amount. All right. So we're really looking at what do we see being produced in a country and what is its value. Now, if this video works for you and you understand what you're done, great. If my way to explain it doesn't work very well, go online. There's a million videos about GDP. So you can find something that works for you. So here we go. I will go along with your notes so you can fill your notes in as we go. So to begin, let's explain GDP. Well, it stands for gross domestic product, and it means the total market value of all the final goods and services produced annually in a country. So you're looking at the final goods, something that is sold to the person who's going to use it. That would be a final good. So if I buy an apple and I'm going to eat it, it's final good. All right. So it's the total value of all the final goods and services in a country in 1 year. And so we use this to compare different countries. All right. So it's used to measure income of everyone in the economy and also the total expenditures on goods and services. And so this is a good way to measure different countries against each other to see how they're similar or different in terms of how much they're producing. So a country like United States, this year its GDP is around $59,800 per person, whereas Haiti's is around $1,800 per person. So a lot more goods and services being created in the United States per person than in Haiti, for example. So here's our little activity. Does it count? Now, it has to be a final product, meaning it's only going to count if it is going to you and you're using it and it's over with. All right, brakes. Brakes are a car. Does that count towards GDP? The answer is maybe. If I go to the store and I buy the brakes and put them in myself, yeah, that goes towards GDP. If a mechanic buys them to put them in a car for somebody else, it's not part of GDP because the service of the mechanic counts towards GDP, but not the brakes. If they're brand new for a brand new car, it doesn't count because the car is going to count, not the brakes. So it has to be a final product. How about a straw? Again, it's a maybe. If I buy it for my family, it's a final product. If it's purchased for a restaurant, not a final product, doesn't count. Lettuce. Once again, it's a maybe. If I'm buying it for my family, yep. If it's being purchased for a restaurant, for a salad, no. So that's the thing. It has to be a final good, the final product that has been produced. That is what's included in GDP. And so if you buy an apple from the store, final good, that's part of GDP. If a restaurant buys it to use in an apple pie, that doesn't count. That is not part of the final good. It is not the final good, therefore it doesn't count towards GDP. So all these other uses would be intermediate goods. Those are used to produce something else. For example, the screen of an iPhone, intermediate good, apple in a pie, brakes on a new car. Those are all intermediate goods. So why not count these towards GDP? Well, it's pretty simple. If you count them towards GDP, you're double counting them, which makes it appear like you're producing twice as many goods and services as you are in a year, right? So if I'm making a car and the car sells for $30,000, but I also include all the parts, which cost me $15,000. Well, my GDP looks like $45,000, but realistically, all I have is a $30,000 car. And so you can only count them once, and that's why you don't count them if they're an intermediate good, only if they're the final good. So how do we calculate it? Well, let's look at it as a two-product world, right? The only products we make are computers and these really sweet Teenage Mutant Ninja Turtle watches. Love them both. All right, GDP equals the quantity versus times the price of the good and add them together. So we have 2,000 computers. They sell a $2,000 computer. 10 of them sell. That's $20,000. $100 watches. 10 of them sell. That's $1,000. In this country, if that's all you produce, the GDP would be 21,000. So you're literally adding up the value of the goods, and that gives you your number. Quantity times the price of the good, and then you'll add up all the different goods that are produced. Now, there's different sectors for GDP. There's the personal consumption expenditures. So what do we pay to consume goods? There's the investment sector. And so that is going to be businesses. And what are they investing money in? Could be like factories, machines, things like that. The government spending sector, what does the government spend its money on? And then net exports. What is the value of the goods that we ship out of our country? So all those things become a part of GDP. So for this, you're going to do a little reading break right now. You're going to go to a website. The balance looks like this, and you're going to fill in your notes for each of those sections for GDP. So I will open this up. Here we go. So we're looking at the section right here. You'll fill these 4 sections of your notes in. And you're going to notice it has every section. Real simple. There's personal consumption expenditures. And you can, just sum it up, get the main points there. Here is business investment. Includes a few different things. Government spending, number 3, and then net exports. So you can go to that website and fill those in. Awesome. All right. So what does GDP leave out? First off, illegal goods and services, drugs, prostitution in most states, unless it's legal, illegal firearms, all those kind of things. So why doesn't GDP count that? Well, it's pretty simple. Usually you don't have those figures. There's not a whole lot of drug lords out there that are giving the government their numbers for how much cocaine they pushed last year. It's just not the way it works. So you literally don't have the figures to be able to get that, and so it's not counted. Transactions for which there is no record. What is that? Well, maybe you mow your neighbor's lawn and he pays you $20. There you go. All right, you help somebody out and they give you $50. Well, again, you can't count it towards GDP because there's no record of it. They can't trace it, and so therefore it doesn't count. Non-market goods and services, so things that are used that you don't pay for. So for example, if your mom cuts your hair, my wife cuts my hair. Doesn't she do a lovely job? There's not much hair there to cut. Again, there's no payment that's been had there, and therefore you can't really count it for GDP. For example, my dad has a dairy farm and he sells firewood as well. Or not dairy farm. He used to have a dairy farm. He has a beef farm. So sometimes I'll go out and help him bale hay in the summer. And then in exchange, he'll give me some beef and some firewood. So right there, it's a non-market good or service. We're not selling them on the market or bartering, and therefore you can't count it towards GDP because there's no record of that interaction. A few others, stock transactions and other financial transactions. Well, if I'm moving money from one bank account to another, I didn't create more money, right? So that shouldn't work. If I'm selling or buying stock, I'm not creating something new. It's just transferring to somebody different. So that doesn't count either. And lastly, government transfer payments. These aren't counting because, let's say that the government is paying somebody's for Social Security. Well, that money was already in the system. You're just moving it within the system, and therefore you don't count it towards GDP. So typically you don't count it towards GDP because you're shifting money. There's no new product or service being made, or you cannot track this product or service because of it being illegal or it being a cash deal or something like that. All right. One of the big figures you're going to hear about is per capita GDP. Per capita means per person. And so you take the GDP of the country, divide it by the population, and that gives you per capita GDP. So if you look at the United States, we have around $19 trillion in goods and services made in a year. Our population is 324 million people. And therefore, on average, we have $59,800 in per capita GDP. So let's compare that with some other places in the world, shall we? In 2020, that's our number. Russia had 27,900. So they're literally produce half as much as we do in our country. China 18,200. So they produce a lot less than the United States, but they have such a high population that they still produce of a massive amount. In Singapore, $94,000. Whatever they produce, it's valuable. So it kind of helps you to gauge different countries and see what their productive output is. It also shows you how much population matters. China is a force in the world economically. Their GDP is low, but that's because they have so many people that are working. So does GDP per capita, which we just figured out here, does that equal average salary? We'll take this into consideration. A school teacher, their service, does that count towards GDP? Not directly, right? I'm not producing a service as a school teacher that's going to make money in the short term. In the long run, if you're all more educated and you get better jobs, then yeah, it's going to produce some, but short term, no. Does Aaron Rodgers produce GDP? Yeah, he produces massive amounts of GDP. When you see him doing well, ticket sales go through the roof. When he got hurt against the Vikings, sales plummeted to half their prices. And so he has a massive impact on GDP. So the US per capita GDP is around $59,000. The average income is around $48,000. So are they equal? No. These are two very different things. GDP is measuring the value of goods and services produced per person. Average salary is, dictated by what you do, what kind of skills you have, and how long you've served, different things like that. So they're not the same. Don't assume that some country's GDP means that's the amount of money to make, because it isn't. So we're on to types of GDP. So there's a few, all right? The first type is going to be money, current, or nominal GDP. All three of those names mean the same thing. And it looks at GDP in terms of our current dollar prices. So looking at the dollar today, right now, what do we see? There's a big problem with current nominal money GDP. And that's that you can't compare it to previous years, because last year's prices are going to be different because of inflation. And so the factor of inflation is really important. And that's why a lot of people will look at real GDP. And it's going to adjust the amount of GDP to factor in inflation. So you can look at, different years and see how they're similar or different. So I can look at 2010 and 2020 and see, how similar they are and what year was doing better than the other. That's a pretty nice thing to be able to do, because otherwise, if we look at GDP now and we look at it in 1960, well, of course it's going to be higher now because, everything's inflated in price. So real GDP, you have to add in a deflator, and you can look online to figure out what the number is every year to kind of figure out what your number should be. We're not going to have to worry about that. We'll have the numbers ready for us, which is nice. So real versus nominal GDP. If we compare a few years, all right? So these numbers are in billions. It's amazing. It's a lot of money, okay? So as we said, the nominal is going to be current dollar prices. So if you look back to 1950, they only had $280 billion in GDP. And you look at today, we have 20,000, right? Holy moly. That's like 100 times bigger. And so it's really easy to look at these numbers and say, well, yeah, look at how much more we produced than back then. Well, hold it up. You have to factor in inflation. And when you factor in inflation, they really had 2,184. And ours is around 18,000. Now, is that different? Yeah. Ours is about 9 times higher. But in this case, this one is what? 100 times higher. My math's right. I hope it is. So 9 times higher is a lot different than 100 times. It gets even bigger here. It gets even different here, right? In 1970, it's 1,000 compared to 20. No, if you factor in inflation, it's 49 versus 18. And so this helps you to understand it a little bit better. It's kind of like when your grandpa talked about buying a candy bar for a nickel. Well, yeah, it cost a nickel back then because he made maybe $2 a day, right? And so you have to factor in inflation if you want to figure out accurately how much money in goods and services you have in a country. So real GDP is what you're going to go with a lot of times. Issues, warnings about using GDP data. People get things wrong if they only look at this and they don't understand how to look at it. So number one, the data is rough, and many lower GDP countries have incomplete data. For example, 2004, the average per capita GDP in Ethiopia was $113, while the United States was 39,000. Well, the average Ethiopian is very poor compared to us in America, but the difference isn't that extreme. And one major reason is that Ethiopian farmers are largely um, subsistence farmers. They don't necessarily trade a lot of their food. And so a huge chunk of Ethiopians are producing food that they eat, and therefore it doesn't count as GDP. And so the number for Ethiopia is substantially lower than what it actually would be because a majority of their goods, their food, is not being counted towards GDP. Whereas in the United States, very few people are producing and eating their own food. And so all of that food counts towards our GDP. So that's something you have to figure in. Is this a farming economy and are they farming for themselves? If they are, then you have to factor that in. Per capita GDP is an estimate. It does not measure the distribution of money. It does not equal average income, right? So like I said, I don't really produce GDP. Aaron Rodgers produces a ton, okay? And so it's an estimate per person. It's not like a baby comes out and all of a sudden produces $59,000 worth of goods. It'd be amazing, but we haven't gotten there yet. So it's an estimate. It's not a per person, like actually every person does that. Extreme example, a country with a per capita GDP of $12,000 could have half the population with an income of $20,000 and half with an income of $4,000, right? So, you know, it's not an average income. GDP shows materials and services produced. It does not measure happiness. Just because your country produces more goods does not mean they're going to be more happy. It's kind of like some of the people I've worked through. I've worked for some different people doing landscaping and stuff, and the wealthy ones, a lot of times, are not that happy. So don't say, oh, we got more money, we're better. It's not always the case. And GDP does not reflect costs of living, all right? So it does not show how expensive it is to live in an area, right? To live in New York City is a lot more expensive than to live possibly, like we said, in Ethiopia. And so GDP doesn't reflect those costs and those types of things. So there you go. US has a much higher GDP than Guatemala, but it also costs a lot less to live in Guatemala. And so you have to factor all those things in when you're trying to figure out, you know, the value of goods and how it impacts their salaries and what that means. That's it. That's my last slide. I can't go any further. So that's what I got. If you have any questions, let me know. I'm happy to help you. And I hope this helped you to understand GDP. We do have that intro video and the intro article as well, if you need a little more help in understanding this. But we'll go from there. I hope you have a great day. Take care.